Hi, this is Dr. Jessica Dunn, and today we're going to be discussing free cash flow. Free cash flow is the amount of cash available from operations that are available for distribution to investors. These are the distributions available after all necessary investments to support operations have been made. By establishing how much cash a company has once bills are paid, free cash flow is able to cut through the guesstimations involved in reported earnings. So free cash flow tracks money. Growing free cash flow frequently prelude increased earnings. Companies that experienced increased free cash flow, so that would be revenue growth, efficiency improvements, cost reductions, they do have the ability to reward their investors tomorrow. So we frequently see that free cash flow increases before increased earnings. So free cash flow is a good measure of value. There are some problems with free cash flow. First up, there's not a regulatory standard for determining free cash flow. So if you were to log on to Mergent or Yahoo, they may have different valuations for free cash flow. So they may have calculated them in different ways. And so because of that, if you are using free cash flow as a method for performing research, it would be advisable to get all of your free cash flow calculations from the same website. So if you weren't calculating it yourself, if you were using someone else's calculated numbers, then you would want to gather all of those ratios from the same website to ensure that you're using the same definition for free cash flow. Another problem with free cash flow is that it can be temporarily boosted. So companies could deceive investors by boosting their free cash flow. Ways that they can do that would be to stretch out their payments, to tighten their payment collection policies, or to deplete inventory. There are 5 uses of free cash flow. So the money that's available after all obligations have been met, all necessary investments to support operations have been paid. With that free cash flow remaining, we can pay interest on any debt that we owe. That would be the first obligation. Beyond that, we would need to pay back any principal on debt. Third, you could pay dividends. Fourth, buy back stock. And 5, buy non-operating assets such as marketable securities or investments in other companies. So having free cash flow is good for a company because it gives them options. They have the ability to pay interest and to pay principal, to pay dividends, to buy back stock, to make investments. But at the same time, too much free cash flow can be a bit of a problem as well, because it creates too much incentive for investors or for managers to waste money. So just like you and I, whenever we have plenty of money in our account, we may not do our due diligence when making purchases. It makes us a little less cautious when we have plenty of cash laying around. And managers are the same way. If they have excess cash laying around that has no obligations tied to it, then that may encourage them to make riskier investments. And so we're going to discuss how to calculate free cash flow. And so free cash flow, the first step is we calculate net operating profit after tax. That goes directly into step 5. In step 5, we take our net operating profit after tax and deduct from that our net investment in operating capital. But we have to go through steps 2 through 4 to calculate our net investment in operating capital. So step 2, we take our operating current assets and deduct from that our operating current liabilities to give us net operating working capital. Step 3, net operating working capital plus operating long-term assets gives us total net operating capital. And step 4, we take our total net operating capital this year and deduct last year's to give us our net investment in operating capital. And so here's the example that we're using, and this is available to you on Canvas. So you can download this income statement and balance sheet for the calculations that we're going to do in this example. So let's just jump right in. Remember, the first step was to calculate net operating profit after tax. So that's earnings before interest and tax times 1 minus the tax rate. So step 1 is to calculate net operating profit after tax, which is earnings before interest and tax times 1 minus the tax rate. So if we are to look at the Computron income statement and balance sheet, we see that their earnings before interest and tax, which is found on the income statement for 2010, is $17,440. We multiply that by 1 minus the tax rate, which is given to you as well. The tax rate is 40%. And so that gives us 10,464. So the second step then is to take your operating current assets minus your operating current liabilities. But let's first discuss what our operating current assets are and what our operating current liabilities are. Okay, so operating current assets are the current assets that are needed to support operations. So these include your cash, your inventory, and your receivables. They do not include short-term investments because they are not a part of operations. So for example, let's calculate our operating current assets for 2010. So it includes our cash on the balance sheet. We have 7,282. Add to that our inventory, also on the balance sheet. And I got 1,287,360. And our receivables, 632,160. That would be operating current assets. That gives us 1,926,802. Now let's do the same thing for 2009. Operating current assets for 2009. So our cash, inventory, and receivables, we have 9,000 plus 715,200 plus 351,200. And I got 1,075,400. So operating current liabilities then are the current liabilities that result due to normal operations. These include accounts payable and accruals, but not notes payable because that is a source of financing and not due to operations. So let's calculate our operating current liabilities for 2010. It includes our accounts payable and our accruals. So 324,000 plus 284,960 for a grand total of 608,960. For 2009, we have 145,600 plus 136,000. That's a K. Ks are thousands. And that gives us a total of 281,600. And the reason why I calculated these for multiple years is because at the end of this, we have to deduct the totals for over 2 years. So let's go ahead and calculate our net operating working capital, which is operating current assets minus operating current liabilities. So let's do that for both years. For 2010, we had operating current assets of 1,926,802. Subtract from that our operating current liabilities for 2010, 608,960, for a total of 1,317,842. Now let's do the same thing for 2009. Net operating working capital for 2009. Operating current assets, $1,075,400 minus our operating current liabilities of $281,600. And that gives us our net operating working capital of $793,800. Okay, so on to the next step. Here we need to calculate our total net operating capital, which we also call operating capital for short. Operating capital is equal to net operating working capital plus net fixed assets. So let's calculate our net operating capital for 2010. So our operating capital for 2010 is equal to our net operating working capital for 2010, which we just calculated on the previous slide. We had $1,317,842. Subtract from that our net fixed assets, which is our net plant and equipment listed on the balance sheet. So that's $939,790. So that gives us operating capital of 2010 of, oh, I'm sorry, that's a plus, isn't it? $2,257,632. So now let's do operating capital 2009, which are net operating working capital from the previous slide, $793,800. And we add to that our net fixed assets, our net plant and equipment, $344,800. And so that gives us operating capital in 2009 of $1,138,600. So I'm just going to go ahead and include the next step here as well, because all we're doing is calculating the difference. So it would be operating capital this year minus operating capital last year to give us our net investment in operating capital. So our net investment is equal to $2,257,632 minus $1,138,600. So this year we've invested $1,119,032 in our operating capital. So now we're ready to move on to the fifth and final step, where we take our net operating profit after tax that we calculated in step 1 and subtract from that our net investment in operating capital that we just calculated here, $1,119,032. So free cash flow is equal to our net operating profit after tax from the first slide, $10,464, minus our net investment in operating capital from the last slide, $1,119,032. And so our free cash flow is negative, the negative $1,108,568. So negative free cash flow, is that good or is that bad? Now it depends. If the money has been used wisely to implement growth and they've earned an adequate rate of return, then investors aren't going to be upset. But a company cannot survive year after year with negative free cash flow, and sometimes they aren't using money wisely to generate that negative free cash flow. Sometimes they've wasted shareholder returns and they haven't earned an adequate rate of return. So let's see how this free cash flow was used. So we said that the first use of free cash flow was interest. So you make interest payments on your debt. So let's look at our income statement, and we see interest expense in 2010 is $176,000. And we pay taxes on, multiply by that by 1 minus the tax rate. And so that's $105,600. Second, we could use the free cash flow to reduce debt. If it's negative, however, that would be increasing debt. You borrowed money. And so let's look at how our debt balance has changed year over year. So we're looking at the change in our notes payable and our long-term bonds. So let's first calculate the amount of debt we had in 2009 and subtract from that the amount of debt that we have in 2010. So our notes payable and long-term bonds in 2009, we had notes payable of $200,000 and long-term bonds of $323,432. So adding those together, we have $523,432 minus our debt in 2010, $720,000 plus $1 million. $1,720,000. So we see that they did increase the debt by $1,196,568. The third use of free cash flow is to pay dividends. We see that in 2010, they paid dividends of $11,000, and that's given to you on the spreadsheet. Fourth, you could repurchase or issue stock. And we see that our shares outstanding have remained constant, and so there is no change, so that's 0. And fifth, we can purchase or sell short-term investments. And so here we see that the short-term investments balance in 2010 is $20,000. In 2009, it was $48,600. So we have sold short-term investments of $28,600. So when you sum all of this up, the total, you get a negative $1,108,568, which is what we calculated here. So we get the same number, so that's good. But when you're looking at this, you see that they borrowed a lot of money. They even sold some of their short-term investments and used that money. So we don't know if this is wise or not. Let's look and see how well the company is utilizing the capital that's invested in this business. To do that, we calculate return on invested capital, which is net operating profit after tax divided by operating capital. These are all numbers that we've already calculated previously. So all we're going to do is just plug them in and see them in a different light. So our net operating profit after tax for 2010 was $10,464. Now that was step 1 from free cash flow. So you've already calculated this. It was earnings before interest and tax times 1 minus the tax rate. We divide that by our operating capital, the $2,257,632. So with that, that is also from our free cash flow calculations. So that gives us 0.5%. So we're not yielding a great return on that capital that we're using that's been invested. If we were to have calculated this for 2009, you would see that they had an 11% return on invested capital. So they were doing much better. So if the firm's cost of capital is 10%, did the growth add value? And the answer to that is no, because the return on invested capital of 0.5% is less than the weighted average cost of capital of 10%. So investors did not get the return that they require. Like I said though, sometimes we do see negative free cash flow, And that's okay as long as our return on invested capital is greater than our weighted average cost of capital. Economic value added, this is the value added to shareholders by management. And so it's measuring managerial actions during a given year. So the formula for this is economic value added is equal to the net operating profit after tax minus the weighted average cost of capital times our operating capital that we've already been using, this $2,257,632. So I guess maybe I should make that clear, operating capital. Okay, so let's calculate economic value added for 2010. We know our net operating profit after tax was $10,464. We were just told that our weighted average cost of capital was 10%, which is also given to you in that spreadsheet. And multiply that by your operating capital for 2010, $2,257,632. That gives us economic value added of a negative $215,299. So that means that this year managerial actions have destroyed $215,299 in value of the firm. If we calculated this for 2009, you would get $11,600. So in 2009, managerial actions improved firm value $11,600. In 2010, they destroyed $215,299 in firm value. Which I just did this. Okay, so here's our stock price and other data that you can also find on that spreadsheet. We see that in 2010, our stock price has fallen, which is another good indicator that we've had some problems and that shareholder value is being destroyed. Earnings per share has gone from 88 cents to a negative 95 cents, and our dividends per share has been cut in half. Market value added is the market value of equity beyond the book value. So it measures the effect of managerial action since the inception of the firm. And we calculate market value added as the market value of the firm minus the book value of the firm. So let's calculate the market value added in 2010. We see that the market value added is equal to the market value of the firm minus the book value. The market value is simply shares outstanding times stock price. So in 2010, it's going to be $600,000. 100,000 shares outstanding times $6. And from that, we deduct the book value of our equity, which is $557,632. So that tells us that their market value added in 2010 is $42,368. So remember, this is since the inception of the firm. So since this firm has been created, managerial actions have improved the value $42,368. Now let's see what it looked like in 2009. In 2009, the stock price was $8.50 per share, so $850,000. The book value of stock was $663,768. So that gave us market value added of $186,232. So we can see again that market value added dropped from 2009 to 2010, which is reiterating this story that managerial actions have destroyed firm value.